Hello, Professor Trần Đức Thanh, along with everyone in our class. Today, I, along with everyone in Group 1, would like to present to you one of the recent events that have caused the most significant damage to the US economy, known as the bankruptcy of Silicon Valley Bank, or SVB for short. Before starting today's presentation, I would like to introduce you to everyone in our group. We have Lâm Kim Anh, Phạm Huỳnh Nguyệt Anh, which is me, and Nguyễn Xuân Bách. And here are the table of contents that we'll be presenting, and I will be presenting to you on the first 3 chapters. So for the first chapter, which is the introduction, I'll be telling you about all the information along with the objectives for the later parts. So as you can see, Silicon Valley Bank was founded in 1983, and it was known as one of the 16 largest banks in the US with $212 billion of assets, according to the Federal Deposit Insurance Corporation, or FDIC. And what they did was they specialized in financing and banking for startup companies, mostly technology companies and healthcare, and most of them are considered to be very, very successful. However, on March 10, 2023, the bank went from solvent to broke for many reasons, making customers become very worried, and they have to withdraw the deposits simultaneously due to fears of the bank's insolvency. And as a result, it went bankrupt in just 2 days, making it the second largest financial crisis ever since 2008, which they lost over $300 billion of assets. And as can be seen, the bank just doesn't collapse by itself. There has to be some reasons for it to collapse, right? So on the next objectives, we'll be digging deeper into the factors that have contributed to the downfall of Silicon Valley Bank, along with some analysis and assessment in the Silicon Valley Bank collapse event. And then finally, we're going to evaluate the effectiveness of the word after the Silicon Valley Bank bankruptcy. We'll be moving to chapter 2, which is the theoretical basis and how they're connected to the events. The first one, we have the demand and the supply. The demand is the ability and willingness to buy specific quantities of a good at alternative prices in a given amount of time. On the other hand, supply is the ability and willingness to sell or produce specific quantities of a good at alternate prices in a given time period. And as you can see, all the charts describing both of them. Next, we have bonds, which is a type of debt security similar to an IOU. And a bond is normally issued by a government or a corporation for investors to lend them money for a certain amount of time willingly, and it is normally paid back to the investor as principal plus interest. There are 4 main types of bonds here, which are corporative bonds, investment grade, high yield, and municipal bonds. In this part, I will focus only on corporative bonds. When SVB was having a lot of problems, they decided to sell all their corporative bonds. Unfortunately, the interest rate has increased from 1.75% to 3.9%. So, for example, if they sold about $21 billion worth of corporative bonds, they will lose up to $1.8 billion. And they have bought totally about $128 billion. So you can imagine how large the amount of money they have lost is. And then finally, the main reason of it is inflation. Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a market of selected goods and services over some period of time. And some causes of inflation is that a country's money supply can be increased by the monetary authorities by printing and giving away more money to the citizens, legally devaluing the legal tender currency, and loaning new money to existence at the reserve account credits through the banking system by purchasing the government bonds, banks on the secondary secondary market as the most common.
Inflation can be classified into three types. That is demand pull, cost push, and fueling inflation. Demand pull inflation occurs when an increase in the supply of money and credit stimulates the overall demand for goods and services to increase more rapidly than the economy production capacity. It creates a demand supply gap with higher demand and less flexible supply, which results in higher price. Secondly, cost push inflation is a result of the increase in price working through the production process input. This means the cost of energy can rise and contribute to rising customer price, which is reflected in various measures of inflation. And finally, being inflation is related to adapted expectation or the idea that people expect current inflation rate to continue in the future. The increased wage result in a higher cost of goods and services, and this wage rise spiral continue as a factor induce the other and vice versa. Well, let's move off offshore and compliant data. SVB collapse came mostly from exogenous factors, for example, from investors who deposited money at banks and the decline of the US economy. We often say credit means lending by credit with trust, and once the trust is disappeared, it is no longer here. The relationship between the lender and the borrower will end, and it could a change collapse in the whole system. Because this is the core bank of Silicon Valley, there are many venture capitalists who have put billions of dollars here. SVB investment in government bond is longer government, even though it earns very low interest rate, but its risk is almost zero. The figures show that there is a significant increase in the amount of deposits since 2019, when the bank's assets increased to 50 billion USD. This threshold of assets where SB will be considered a bank with a system important role and subject to stricter supervision by regulatory management increased to 189 billion USD at the end of 2022.
Well, let's go to the chapter 4, analysis and evidence. The story is only okay when the bond interest rate stabilize and turn out that the main cause of the SVB collapse. Here are very few reasons. Well, the first is the objective reason. Because of the COVID-19 pandemic with Russian-Ukraine wars, you can see that people can buy bond at the price Q and interest rate in the figure I saw in the model. However, due to the general economic situation since the time of COVID-19 in the past few years, and also the Russia and Ukraine war, we know that the war, especially in the US, has gone down a lot, and the Federal Reserve System has done to control the inflation to reduce the full decrease in the currency. They raise interest rates, so the average rate of the security adjust for 10 years equal 10 is now up to 4%, but only at the end of 2022. This curve of the supply so that the consumer thought that their bond will lower with the normal price in the market, so the total value of their bond will decrease. Now there is a new point with interest rate I phẩy and quantity bond Q phẩy. By increase the interest rate, the government aim to reduce the consumer spending and borrowing, which can moderate inflation pressure. Moreover, it's essential to understand that the inverse relationship between the bond price and the market interest rate. When the market interest rate rise, bond price decrease, and vice versa. This principle implies that the value of the bond move in the opposite direction of the market interest rate. SVB financial performance were impacted by the prevailing economic situation and Fed effort to control the inflation. The bank saving rate and the bond interest rate has to be adjusted to reflect the changing economic landscape. However, This adjustment led to the lower return for the investor compared to the broader market. And inherent relationship between the bond price and market interest rate further complicated the bank financial situation. The next reason is the capital-hungry investment fund. Another factor contributing to the collapse was the pressing need of additional capital by venture capital funds to fulfill a commitment to the company they had invested in. This requirement prompted them to urgently withdraw funds of the bank. This magnitude of the crisis became evident on Thursday, March 9, and when the customer flocked to SVB to withdraw their savings deposit, resulting in the security outflow to over 42 billion in one single day. And consequently, the bank were compelled to sell 21 billion worth bonds at the worst possible time when the market rates were exceptionally high and the bond price were at the rock bottom level. This unfortunate situation led to a significant loss of 1.8 billion for the bank. Next of all is the panic of the majority. The bank found itself in a precarious situation as it had to grapple with substantial loss of coupon payment to ensure enough liquidity for struggling startups they had invested in. SVB had to accept these losses. In an attempt to remedy the situation, SVB made an announcement regarding to its effort to secure new capital with assistance of the Golden Shark and initial the sale of shares to raise an additional 2.25 billion in the capital. However, the irony was that this move resumed investors to have opposite effect. The news of seeking new capital and selling shares instilled fear and doubt among the venture capitalists. As a result, concern about the bank's aggressive asset selling strategy to pay off the debt. This consequence was dire and immediately the stock price of SVB plunged from 268 on the Wednesday to March $106 on the Thursday, resulting in the freezing of further trading on Friday morning. Simultaneously, the bank market value experienced a catastrophic crash, sending shockwaves through the financial market. The perfect storm of panic, massive asset sale, and the withdrawal of investor funds dealt a fatal blow to SVB, culminating in its collapse. The once thriving bank future now hangs in uncertainty, leaving the trail of loss and settle investor confidence in its way.
Causing the bank to sell a lot of assets. However, Silvergate's total assets are only $11 billion, which is nothing compared to SVB's $212 billion. And what happened next? 40 years of operation for a Silicon Valley bank, it completely dissipated in just 14 hours. After that, many CEOs of startups were also worried that they do not have money to continue to pay employees to continue operating a company, and they have considered having to take a bank loan or let employees quit. This case is also somewhat similar to the case of Saigon Commercial Joint Stock Bank, SCB, and we have run recently. What will happen next? We do not know. However, there is one thing in common when we look at the news and read articles from experts analyzing this case. They also that this case is different with the time of 50 years ago from the time of 2008 crisis, because now there are a lot of financial risk management tools that have been put in place. There are more control points citing the liquidity issue. Examining SVB's financial statements by the end of 2022, a remarkable facet unveils itself. Up to 62% of their assets composition comprise highly liquid holdings. signifying prudent financial management. Time and again, SVB has proved its method in surmounting various crises that have cast shadow over the financial landscape. Explore a conclusion. In conclusion, the collapse of Silicon Valley Bank and the consequent destabilizing impact in the banking system raise serious concern about how to shape the regulatory and oversight policy going forward for long-term stability in the banking system. The